Hello, and welcome back to the Coin Story Show, where we get to hear from the leading voices in Bitcoin, financial markets, macro, and even beyond. This podcast does not provide financial advice, it is for educational purposes only. These episodes and interviews wouldn't be possible without my partners. So first up, Okcoin. Okcoin is one of the fastest growing and most secure global cryptocurrency exchanges where you can buy and learn about Bitcoin. Okcoin is committed to investing in educational content, funding Bitcoin and Lightning Network developers, as well as supporting crypto entrepreneurs from underrepresented groups so that we have a more diverse pool of talent that works on Bitcoin ecosystem projects and careers. Okcoin has contributed more than $1 million to core devs and counting, and has one of the most active Lightning nodes. I also love that you can toggle between Bitcoin and Sats mode. And if you want to get started investing, head to okcoin.com/Natalie and get $50 in Bitcoin when you sign up. All right, Sven, it's so nice to see you for round two. I'm excited to talk macro with you. How have you been? You look like you're in a very nice setting.
Yeah, we got a little wild weather going here in the UK. We had the hottest day ever, 40 degrees, which is insane. I've been
Wow.
in many hot places before, but usually with AC. And now we have no rain. You think always, last year it would rain all the time, but now it's just drought. We have no rain. See the grass behind me is dying, and everything's just so. May as well sit outside because when winter comes, we'll back inside, right?
Yeah,
I'm
and
good.
maybe we can touch on a little bit of that because the European energy crisis and all of that going into winter is just really shocking to read about. But I want to start with a little bit of the macro picture. Jobs was one of the most recent reports that came out, and I think the administration is celebrating because unemployment dropped. But caveat, a lot of those numbers are because people are working multiple jobs. We're losing full-time workers. So what was your take on that release report?
We're in a really interesting time because we have the fundamental aspect of it, but we also have the political and the monetary aspect, and even the monetary aspect is very political. And I'll give you a specific example. It was really refreshing yesterday to see the Bank of England come out and set everyone straight, and that is we're going to go here in the UK. We're going to go into a recession. That's the expectation, and they're preparing everyone for a year out. Just be real about what's going on here. Yes, there's a lot of rollovers on the inflation front, and the markets have been pivoting of that in recent weeks, namely with the Powell pivot. And part of it, just put the equity rally in context. Mid-June, I've been screaming larger bear market rally coming, mainly because of all the technical factors. We were massively oversold because if you're in a bear market, you get these dips and dips and then rips and rips, but then you get a really nasty one and everything gets really wildly technically oversold. And what is the psychology of a true bear market rally? We had those in 2000, we had those in 2008. And this is the big question for all of us right now. Are we again in one of those, okay, it's a bear market for a few months and then we just go off to the races again? Or is this going to be a much more extensive bear market that lasts for years or a year or 2 years? We don't know that yet. And that's why we got to look very closely in terms of what's happening, not only inflation front, but in the technical front, but also the monetary front. And so that's this jobs report. What the jobs report is telling us at 3.5% unemployment is two things. One is history says 3.5% unemployment is one of the most dangerous times in the economy, because that's typically when the Fed needs to tighten from an overheating economy perspective. And obviously we are in a tightening cycle right now. And everybody's kind of been gaming the Fed pivot, and Powell kind of kicked the can a little bit verbally during the press conference. That's when equities really kicked into gear. And it didn't matter what the other Fed speakers have been saying, because they've been saying, we need to get to 3.84% effective Fed funds rate. The problem with all this is there's been no history, none, zero, where you can get rid of inflation with a 3.5% unemployment rate. You just don't. Okay. The other problem is historically, and I've been banging kind of the drum on this, the debt construct has gotten so insane over the last 20 years, especially even in just the last 4 years with COVID and everything else, and tax cuts, you name it. This all filters through. We added $9 trillion in debt since 2018. 2018 was lights out what the 10-year got to 3.2%. That's when we had the 20% correction, and then the Fed flip-flopped, right? That was the famous flip-flop in January 2019. And this summer, this is really important, 3.5%. We got to 3.5% on the 10-year, which was a massive move from 1.5% in just a few months. Okay, the velocity was stunning. And guess what? That was when the equity markets bottomed, because they were sending a very clear signal. If you keep this up, we're going to go into a deep recession. The market construct cannot handle higher yields on a sustained basis, cannot do it. And look at just recently the few rate hikes they've done, which got them back to the 2018 levels, which was 2.25%. That's how far they got before they pivoted and cut again. The interest payments on debt are ballooning high at over $600 billion already. That does not account for the latest 75 basis point rate hike. Okay, so this is all still filtering through. And may I remind everybody, QT hasn't really started yet. They're doing some softish QT at this point, but it's really going to kick into gear in September, October, November. Okay, so there is this notion now that everything's priced in and there is not going to be a recession. Well, that will be a miracle on Wall Street, literally. Right, that's basically where we're at, and this is what we're gonna have to see negotiate itself through over the next 6 months.
Well, first of all, we are in a recession, aren't we? I mean, I love following your hot takes on Twitter, because when the administration comes out and tries to change the term, you're one of the first people to go, "What are you guys doing? Are we in a recession?"
Well, here's the thing: if typically what you say with 3.5% unemployment, you can't be in a recession, right? You also have to, 2 quarters in a row negative GDP growth. Historically, that always turns out to be a recession, right? Now, to be fair, we got off some very hot numbers last year, right? Because they were printing and giving money away free in bags, literally, right? So I view this all kind of a political game as well right now, vis-a-vis the Bank of England, who is explicitly warning about a recession. The Fed, for example, is putting out, in June, they put out a effective Fed funds rate forecast out of 3.8%, which is breaking the historic downtrend. And I have no problem with them doing that. I have absolutely no problem saying, okay, rates need to go higher to combat inflation. Fine. Be absolutely no problem with that. I've been saying higher rates for a long time is really necessary. But then don't, or at least be intellectually honest, and don't put out a permanent positive GDP growth forecast. I mean, this is where I have just issues with the way this is being jawboned. And part of it, and this has been going on for a long time, is it's really about jawboning in terms of maintaining confidence. If Ben Bernanke went out in early 2008 and said a big bad recession is coming, guess what? Everybody would have panic sold. Instead, he said, there's no recession coming, and everybody got trapped big time. The Fed will not tell you a recession is coming. They're counting on this NEBR institution to officially declare a recession. And guess what? They will always do it after the fact. There's not anyone that's going to tell you in the U.S. political monetary sphere that a recession is coming. And keep in mind, we also have midterms coming. Recessions look really bad before political elections.
Yeah, so I'm just saying, word you don't want to hear.
Whether we're in a recession or not at this point, in terms of we may be in a technical recession, but even if we were in a proper recession, there is structural, political, institutional resistance to admit to it. That's based on history. Going back to that jobs report, net full-time jobs went down. Part-time jobs went up. Mm-hmm. Double jobs, second jobs went up. Why? We're seeing it in the data. personal savings rate has absolutely collapsed. Credit card spending is going through the roof because people are not keeping up. We've since last year, since April of last year, on a real basis, wage growth has been negative. You can run an economy on negative wage growth for only so long. So, what needs to happen here is really, by the way, if inflation comes down in the next few months, let's say CPI reports, we already see it on the PMI side, the prices are coming down. Well, newsflash, that doesn't mean prices are going back to where they were. It just means the rate of growth or the rate of price increase is slowing down. You're still stuck with much higher prices than you were before in a lot of cases, right? So if your rent's not going up 10%, but now it's only going up 6%, it's still going up, right? So that's one. And then the second one, while everybody's celebrating here with inflation peaking, you may want to take a close look as to why inflation is peaking. And it's peaking because growth has slowed down dramatically. And I'll finish on this note. This is really important. We have really three examples of high inflation, above 8% since the 1970s, 1974, 1980, 1982. And guess what happened? Every time we went into recession. And the hard truth is, ultimately, to get rid of inflation properly, you need to have a recession. And that is the message they will never tell you, right? So that's the problem. So whether we're in a recession now or not doesn't really matter. I think what matters is where we're going to be a year from now in vis-a-vis inflation. And since mid-June, and especially since Powell's press conference, financial conditions have completely lightened up, which is exactly counter to what they officially wanted to do, which is to tighten. You're not going to get rid of inflation by loosening financial conditions. So I just finish on this point here. We're all in a really complex macro journey, okay? And unfortunately, we have voices that are on the cheerleading side. And I'm not coming here as a raging bear. I've been bullish since mid-June. And it's been a wonderful rally, 20%. Yesterday, I put out an article where I'm getting a little cautious here and say, look, this is part of the psychology. When everybody comes back and says, okay, well, we were really bearish at the bottom is going to fall off. We're going to call for lower prices, SPX 3000. Everybody's going short because we've been in an extended bear market. And then and this is why you get these bear market rallies, because everybody's wrongly positioned. You get these massive rips. And then comes the second part after the rip is everybody's getting bullish again. It's over. New highs are coming. Yay. Yeah. And then people get sucked in as shorts are covering, thinking the worst is over. I don't know yet if that's the case here, but I certainly can make the case here that in the next few weeks, the narratives will get tested one way or the other.
Well, I want to get your take on what you expect to happen with the next Fed meeting in September, because I think even after the jobs report, it seemed like the market was expecting maybe an even more aggressive hike. But one note I will say on the recession front, coming from a media news background, I don't care what your politics are at all, but I will say that I agree with what Peter Schiff tweeted, that if Trump was in office, the media headlines about, let's say if Trump's administration said, no, it's suddenly not a recession, two consecutive quarters of negative GDP growth, the media would be all over calling this a recession everywhere. And today, because of who's in office, they're really not. They're kind of going along with this redefined version that we're not so much in a recession. And that is so disappointing to me, because we really are polarizing the country even more depending on who's in the office. And so anyway, I just wanted to say that. No, I don't know if you agree, but I think whether we're in a recession, according to the media, depends on who's office personally. But as far as Fed tightening, you mentioned they haven't really, they've been expanding the balance sheet still, right? So what do you expect when that happens in September along with the Fed meeting?
Well, the balance sheet peak kind of at the beginning of this year. They started QT officially in June. And in the first 2 months, they managed to reduce the balance sheet from its peak by roughly 25 billion. So it's a really slow walk at this point. The only reference point we have to the Fed reducing its balance sheet was the period between 2015 and 2018. And they were able to reduce it by about $750 billion in total, coming off of a peak at the time of 4.5 trillion. They got to about 3.7 trillion, and then they flip-flop again, expanding again. And people like to maybe reference that as saying, hey, the Fed can reduce their balance sheet without blowing things up. Well, a couple of reminder points. Right after their first rate hike, unfortunately, I've been watching this stuff so long, it's all burned into my brain. After the first rate hike in December 2015, they paused in March 2016. Why? Because everything was blowing up. Financials had dropped 23%. So Janet Yellen paused the rate hikes, but they were able to continue on the quantitative tightening. Why? Because the earth is not flat, despite popular belief. And the ECB and the BOJ, they were printing like mad. They added $5.5 trillion to their balance sheets between 2016 and 2018. And then we had the Trump tax cuts. So basically, the only reference point we have for quantitative tightening with the Fed reducing its balance sheet was in the context of global liquidity still expanding. Right. So now we're in a different world, right? Because everybody is tightening. At least, we're trying to get the ECB back on board. They managed after 11 years, they finally managed a rate hike. Congratulations. And their current, I guess, method of fighting record all-time high inflation is zero rates. We'll see how that goes. But the problem, as you mentioned at the outset, Europe has massive problems. UK just called, their own central bank just called for a recession. Germany retail sales down 3.7% this week. And obviously no solution in sight to the energy crisis, right? Because that part, I may blame central banks for a lot of things, but I cannot blame them for this. A lot of this is politically driven with the Russia-Ukraine war. So unless there is some political solution, and by the way, maybe also be mentally totally flexible. If you see a political solution to Russia-Ukraine, whereby, and I'm just speculating here, right? Ukraine gives up some territory. Russia says, okay, we'll declare victory, and that's the end of it. Notice there was a grain agreement in recent weeks, right? Global food prices dropping. If you got that going, you're gonna have a massive melt up in everything, right? Because then all of a sudden the structural inflation actually is gonna go away really quickly, at least on that part. On housing, God knows, because we haven't really started yet on the mortgage-backed securities sell-offs or any of that sort, right? Because the Fed unfortunately has chosen to purchase $1.5 trillion in mortgage-backed securities in a supply-constrained housing market, which has blown up housing prices everywhere, right? And now yields have been coming back down, right? And so, whatever tightening there was, it's getting reversed again. So it's a tricky journey. Let's put it this way.
So do you think that they will keep being aggressive, and how much room do you think that they have?
Well, this is where I'm kind of just baffled by the numbers. Again, this is really important. 2018, 2.25% is as far as the Fed got. It hit that historic downtrend that we've seen in the last 40 years. Ever more debt to GDP ever higher. And keep in mind, this example people say, folk or 70s, they kept raising rates. Debt to GDP was 30% then. It's 125%. We have a massive debt construct. Corporate debt, all-time highs, government debt. It's not only that it's high, it's that it's extremely high in relationship to the size of the economy, and valuations relative to the size of the economy are still massively high. So if you're telling me that we are now with the highest debt levels ever going to rate levels that are expanding the historic trend without any damage, you are one hell of an optimist. And again, rate hikes take time to filter through the system. So the rate hike we just saw, the 75 basis points, they have not filtered through the system yet. It takes months. So, and then this is kind of, I said this the other day on TV, believe it or not. I said, sometimes you wonder if the world's run by smart people that are putting us on, or by imbeciles who really mean it. Because I hear the chatter that's coming out of these folks. 4% Fed funds rate, but there won't be a recession. I personally have a really hard time reconciling this with just the data and the reality on the ground. I mean, if they're right, fantastic, but I ain't buying that, and I ain't buying that story without some evidence. And I bring it back to the 10-year yield, and again tied to 2018. Guess what happened specifically? The Fed in 2018 was raising rates. They were reducing their balance sheet, and they told everyone they're going to keep raising rates in 2019, and they're going to keep reducing the Fed balance sheet on autopilot. But here's what happened. In October of that year, the 10-year hit 3.2%. That's when the market dropped 20%. And the bond market, as the market dropped, yields dropped in advance. They dropped all the way through December. And then early January, Powell came out and flip-flopped. So it was the bond market in October that already told the Fed it was over for their tightening cycle. But no one believed the bond market, not even the banks. Goldman, Morgan, they all came out and says 4 rate hikes in 2019. Complete BS. Didn't happen. So now I'm looking at this year, when the 10-year hit 3.5% in June, it just dropped to 2.5%. The bond market is telling the Fed you cannot raise rates to 3.8%. Not going to happen. So this is, I think, what's going to get interesting, because ultimately, the Fed either is going to be putting the U.S. economy in a recession because they're overdoing it now on the rate hike front, or they're going to flip-flop. There's tiny wiggle room in between those two options.
So let me ask you, because I would argue that right now the Fed and everyone in charge is most concerned with inflation. And I don't know if you heard that. I think you actually commented on the Fed president out of San Francisco, Mary Daly, and some of the outrageous comments she made about how she doesn't have to make any trade-offs. She's not feeling the price of inflation because, of course, she's making $430,000 and is going to retire on a nice little pension from taxpayers. But it seems like she even alluded to the fact that they need to get inflation down. So they're willing to have jobs reduce. Do you think that there's maybe a new regime that doesn't, is not going to be so quick to initiate the money printer again, because that's just going to blow the bubble up even more, and it is leading to so much inequality and wealth concentration, and they're actually willing to take it the other direction, even though that's going to be really painful, especially politically?
Well, here, first on that comment, I have to say, I mean, Jesus, how tone deaf can you be? And that, it kind of worries me in general, because several of these Fed governors have never had a job outside the Fed. They're really insulated. Their Fed models are, in my view, completely antiquated and outdated. So they're horribly slow to react. The only time they react fast is as soon as things drop and they need zero rates. Now, they can do that in an instant, right? But in terms of the judgment, in terms of how things evolve, I find them horrifically lagging. So, we're all unfortunately subject to this because we have no vote, we have no say, and these are the guys that are in charge. But in general, my experience is what they say has absolutely no meaning in terms of even their forecasts. They've forecasted higher effective Fed funds rate for many years, and not a single one of them has come to fruition. But let's also not forget this Fed, and you can hear some of these Fed speakers talking about what great credibility they have. Well, if you live in a tower and you're not on Twitter, for example, you can believe all kinds of things. I mean, they have horrible credibility. The fact is, they made a complete mess of it last year with this whole notion of transitory, misread inflation horribly, kept printing too long. And so you can make the case, and this is maybe where I sound, maybe arguing with myself a little bit here. While higher rates may be the solution, but then also a recession is the solution. But there is the risk that they will go too far, not because it's the right thing to do, but because they're worried about their own credibility. And that's why this whole gamut with Powell is really interesting, because they've said themselves, job owning is basically the most powerful tool, forward guidance. And he basically suspended forward guidance in July. Why? And then all of a sudden we have all these other Fed speakers come out trying to backpedal this. I don't believe for a minute that they just make big communication errors. I think there's a carefully crafted communication strategy. There was a time Greenspan, he was the only one speaking, and he spoke once in a while, maybe get some testimony, this, that, and the other. And we now live in an age where they just won't shut up. I mean, literally every day you have days where 4 or 5 Fed speakers babbling nonstop commentary. And go back to last year, every single thing they said was wrong, and yet markets reacted to this. And now we're doing this again. Why are we listening to these people? Seriously, just, of course, they have to vote, I suppose, but again, it doesn't mean anything. So I think there's always the danger that we're all getting misled by this group of bureaucrats that are unelected and have no accountability. I mean, by the way, just a side note here on daily, when she said this, I'm fine, and I don't have to worry about inflation. She and her husband sold all 70 stocks they owned December 28th of 21, just literally a few days before the top.
That's really,
under the auspice, well, we can't do insider trading anymore. Oh, great. But these are people that are voting for programs that cause asset price inflation while they own these assets, so that they directly benefit from it. And now I'm to say that consumers are strong when consumers are clearly struggling with inflation and negative wage growth and rising rents, and it's a really bad look, I think.
Well, would you agree that as far as investors in across the board in financial markets, but also I see this a lot on Bitcoin Twitter, that everyone is expecting the Fed to pivot at some point because they'll go too far. The markets can't handle it because of all the debt. And so there is so much volatility right now. We're in these really choppy waters, but pretty much the consensus is at some point they'll turn, so it'll all be fine. Let's just keep it going for now. We might need to tighten, be a little bit more, have a little bit more austerity right now, but in the end, they always print. Is that sort of the understanding?
Yeah, that will happen. They will cut rates back to zero at some point, I would expect. That's not necessarily good news, though, because the way this works, again, we have to differentiate between a really short-term bear market and an extended bear market. Typically, the Fed raises rates until something breaks, until they break something. That's what happened in every extended bear market ever since. I mean, it broke after they raised rates in 2018, right? It broke after they raised rates in 2007, and they were forced to cut. It broke in 2000 in the bubble, right? Every time they raise rates, something breaks. The problem we have is because of almost 15 years of nonstop monetary excess, the systemic extremes have gotten ever larger, right? In 2000, obviously we had the tech bubble, and they had this, by the way, came partially because of Y2K liquidity, because Greenspan was worried about computers shutting down, so he added a bunch of liquidity. Bam, we had a tech bubble. Then he was forced to pull the liquidity out. We had a tech crash. We had a recession. Then they cut rates as a result of that. That gave us the housing bubble. Thanks. Then they said there's no housing bubble, and then everything blew up because everything was over levered. Well, here we are now, 14 years later, and in December, people were completely ignoring this at the time at their own peril. Some basic stats, which was the market cap to GDP went over 200%, which is insane. The peak of the tech bubble was 155%. Guess what? We just bought in June. 155%, which was the peak of the tech bubble. What the peak of the tech bubble is now our bottom structurally? I don't know. I think the risk is always that something breaks. And then what happens? Then the Fed does cut rates. And by the way, this is the thing. They cut rates inside recessions. So once the recession is acknowledged, they cut rates. And that's what happened in 74 and 80 and 82. But then markets don't bottom until they have been cutting rates for a while because something systemic is going on. And I've been saying this all year too, by the way. What amazed me so far, having seen some of the most extreme technical oversold readings and signals and the extent of the flush down that we saw not only in crypto and tech and everything else, is how orderly and structural everything was. There was no major blowups of any sort. It was I hate to say this because it sounds like I have a conspiracy hat on, but it seemed all very well manufactured because the VIX kept making lower highs and lower highs from lower low to lower low on the S&P, and people were screaming, you can't have a capitulation until the VIX really blows up. It didn't. It was just kind of chugging along. People blame the options complex. I don't know. I mean, if it seemed like a very unusual bear market in that sense. Very controlled, very well behaved. So we'll see. I mean, typically the Fed would cut rates if something's out of control, and we're not there.
We're going to take a quick break from the show to hear from these sponsors. First up, Bitcoin 2023. That's right, plans are already underway for the biggest Bitcoin conference in the world. It's going to be held in Miami next year, next May, and you can get your ticket with 10% off using the code HODL, HODL. This is going to be an incredible event. It grows in size and scale every single year. Take a look at this video from last year where you can see amazing speakers like Michael Saylor, Jack Mallers, Kathy Wood. I was so grateful I got to anchor Bitcoin Magazine's live desk at Bitcoin 2022 and hear from some of the most brilliant minds in the space. You can network with companies, other Bitcoiners from around the world, and the parties and events going on in Miami Beach are pretty amazing as well. And if you don't want to wait until May, I understand. How about Bitcoin Amsterdam? That's going to be held this October. It's going to be the first big Bitcoin conference in Europe, and you can get your ticket at b.tc/conference for either Bitcoin Amsterdam or Bitcoin Miami 2023. Again, use the code HODL, HODL, for 10% off your pass. This episode is also brought to you by Fold. How would you like to earn Bitcoin on every single purchase and spin a fun wheel so that you can earn sats every single day? Fold is the best Bitcoin rewards debit card and shopping app in the world. Whether you're shopping at Amazon or grocery store or anywhere that you go, you can earn Bitcoin on every single thing you buy with Fold's Bitcoin cashback debit card. And you can spin the daily wheel, which is super fun, to earn more free Bitcoin. And people have actually walked away with one whole coin on this thing. Head to foldapp.com/Natalie and get 5,000 sats when you sign up. Now back to the show.
Typically the Fed would cut rates if something's out of control, and we're not there.
Right. So what would you don't have to give me a conspiracy, but like what could attribute to something being a little bit more orderly in fashion? Why do you think that's happening? And I would assume that you don't think that the bottom is in, that at some point something will break, which means we could come down even lower before we start to bounce up.
Well, let me start with the last part first. Do I know that a bottom is in? No, I will not be that arrogant to declare one way or the other. It could be in. At least for this year, I can't say. I am concerned that now we have easing financial conditions again, which is actually getting completely counter to the narrative. I will say, and to see, for me, things are not absolute. For me, things are about the journey and assessing risk reward along the way. Mid-June, risk reward says rally's coming, big one, right? Now we're getting in kind of this wishy-washy area where I can say, okay, technically based on history, we can rally some more. And right now we still see ferocious buying the dip of everything because everybody thinks the worst is over. But then comes back to the original question. Are we in a short-term bear market or in a structural one with inflation still going to be with us for a number of years and rates going to be higher for a number of years, for which we have zero history as of late with this high debt construct? In that sense, then you can make the case that a bear market rally is eventually going to roll over hard. And then we're going to see new lows. And then based on all history, a recession actually does unfold. Question is the timing and the structure of the journey. I'll give you one example. just because history's fun, right? 2000, March 2000, the tech bubble blew up, right? We all now know that. But I think people forget what happened after. We literally chopped in wide ranges for 6 months. There were lows, there were highs, there was lows, there was highs. It was just going back and forth and back and forth. And tech was acting more severe than the rest of the market. But we rallied actually that year in August and peaked at the beginning of September. Everybody thought it was over. It was the worst over, right? But then the recession hit. And it didn't bottom until the markets didn't bottom until 2002, 2003, multi-year journey. Okay. And it got nasty. I mean, this is the time period when the Apples and Amazons dropped 80, 90%, right? Which is the discussion I had with Michael Saylor on Bitcoin and positioning strategy. So this is the unknown country, if you will. And I don't know the answer to that yet. And I think a lot will depend. For example, does the inflation data roll over to the extent that it justifies for the Fed to pivot, which I think they would want. By pivot, I mean slow down or pause. Or is it still pushy enough that they're going to have to get to 3.5%, at which point I think it's lights out for this economy, because I don't think it can handle these higher rates on a longer term basis, not without pain.
Well, and every time that they start to print again and blow up the bubble even further, I mean, we've already gotten to zero interest rates. I thought that the US can't go negative, being the global reserve currency. Can we go negative?
That's a fair question, whether they technically can or not. I remember, again, stuff stuck in my brain. 2016, Janet Yellen, current Treasury Secretary, back then chair of the Federal Reserve, she literally went in front of Congress and she talked about it may be a good idea for the Federal Reserve at some point to be able to buy stocks and corporate bonds directly. It's never been mentioned again. It's never come to that. But if something really bad were to go to happening at some point, I would not be surprised if this comes back up. So there's always the intervention is in their DNA. That's what they've done since 2008. So I guarantee you they hate doing what they're doing right now, but they know they must slow down the economy. And since they've intertwined markets and the economy ever more, see, the old saying says the market's not the economy, economy is not the market. Bullshit. The market is so much larger than the economy right now. The slowdown that we saw, this again, history, just very simple. The reason economic growth has tanked in the first half is because stocks have tanked. In December 2018, that example I keep referring to, when markets dropped 20%, retail sales collapsed. Okay. Last year, more money went into stocks than in the 17 years combined. Okay. Don't tell me this does not influence consumer confidence and spending. It's always all about the market. So my general sense is if they have an opportunity in the window to pause and flip-flop, they will take it. Absolutely. Okay. Question is the when.
Yeah. So we're changing the famous Clinton term, right? It's the economy stupid. It's the market stupid, I guess.
It's always the market.
All right. Well, let's talk a little bit about Bitcoin then, because sometimes it's been the sort of canary in the coal mine and indicates where everything else is going. So what do you think right now in terms of positioning? Because I know you mentioned everyone's been wondering if 17,000 was the bottom, but if we do have a capitulation event, a true liquidity or credit crisis, I obviously think it could go lower. But what do you think in terms of Bitcoin? Is this a really good place for dollar cost averaging? What do you think?
So yeah, quick background. So, by the way, Michael Saylor and I spoke literally at the bottom, right? And we had this podcast. It was the Friday. Bitcoin was trading at 20. I talked to him about this long-term trend chart I had. And I said, risk is to 17,000. As long as it holds, the long-term trend is up. It's fine. Guess what? We bought them 17,500 and rallied back up along with equity markets. So that's maybe the good news. The long-term trend is holding. The bad news maybe, is that the correlation between Bitcoin and the S&P, it's almost 90%. All right. In fact, it's gotten so close that on the weekends I already can tell where the U.S. market's going to open. If Bitcoin rallies over the weekend, I know future's going to be up on Sunday, and vice versa. If it drops, it's not going to be. I mean, it is that closely correlated, and as long as we don't have the clarity on regulation, I think this is just going to continue to be that way. Call it a 5x ETF on the market at the moment. Okay, so if you take then the view maybe the market's at bottom this year, then that's all good news for Bitcoin, right? As long as the correlation is that tight. Problem is, if we do get a rollover in this is a bear market, an extended bear market rally, then I would expect that long-term trend to crack. And I got this chart, it could be ugly, right? I mean, I'm not predicting anything like here, but on that structural chart, I can point to 5,000 or below, which sounds horrific. I'm not predicting it, but technically that's what I see if that trend breaks as a possibility. And it would just put you back in the range. It would just put you back in the range over the last few years. My bullish case on Bitcoin has simply been at the beginning of the year. Yeah, we're in the bear market. It's going to get whacked. I'm going to be patient. I'm not using this as a trade. This is not NorthmanTrader. This is now Northman Investor. I want to be patiently scaling in on weakness and key points, recognizing what the risks are. I have a 10-year time horizon. This is my Amazon, Apple 80-90% drawdown year 2000, 2002 kind of scenario. I don't care where it's at the moment. I'm just gonna keep observing the larger macro environment where Bitcoin is actually being picked up by institutions, as we saw this week, right? The regulation is coming, and the adoption is going to continue to improve over time. And once you have the regulatory hurdles, then I think you're going to get more institutional adoption. But in the meantime, you're going to get the same ridicule that you saw in 2000 when Amazon blew up, and everybody was laughing at Bezos, and look what happened there ultimately. And then, so when you see Tesla taking a big write-off, that you're going to get those type of headlines, obviously. But yeah, it's all correlated, and we don't know whether we're still in a bear market rally now that will roll over, or whether we've made the low now for this year anyway, and see a massive year-end rally. I will offer one caveat. To the extent that in our extraordinary times, seasonality applies. There's something called midterm seasonality. Yes, every election type of background has also seasonality associated with it. And midterms are coming up in November. And typically what you see in midterms, and it's not been tracking perfectly at all this year, because this first half of the year was definitely extraordinary, but it correctly predicted weakness in the first half of the year. It predicted multiple rallies that coincided with that midterm seasonality chart in the S&P. And excuse me, my dog just hit the table. So it was not me that was shaking. But that midterm seasonality chart says more stress into September, October, which may or may not produce lows. I'm looking at this technically I see also bullish patterns if we do drop from here a bit, but it then predicts a massive year-end rally starting basically around the September, October pivot point. I know a lot of people are looking at this as well. Okay, so, and I said this on Twitter the other day too. Bears need to prove their case here. They need to produce new lows, because July, the bad news didn't matter anymore, right? Why? Not because it's priced in, because everybody's expecting that Fed pivot, right? Or they're sniffing out maybe the peaking of inflation, right? And so that's why I think the September will be so fantastic, because in, again, 2000, we peaked with a bear market rally and then everything fell apart. In other cases, seasonality took over and we just rallied into year end. I wish I could give you a definitive reason, a very clear prediction, but I'm going to stay open-minded, and we just adjust as things progress.
Yeah.
For now, at this very moment, we were very bullish from mid-June to this week. We started scaling out of longs. Now we still have longs, but we're kind of dabbling on tactical shorts because there are issues with this rally. One is just one open gap after another. So I think has some work to do to the downside at some point, but risk remains higher as long as you don't see a significant rollover.
It's such an interesting time, Sven. I mean, I definitely thought that Bitcoin would ascend to six figures before it came crashing down. And I thought that maybe a support level would be in the 40 to 50,000 range. I just thought we would have more of a blow off top. And I think a lot of people did as well. So when you mentioned things like, the reality is we could shop along for years, just like you mentioned in the dot-com bubble, and it could go even lower, a year or two from now. And it's so hard to imagine because there's already been so much excess, especially in crypto, that is drained with all these crypto platforms that were over leveraged and, filing for bankruptcy and all that. But there could be a lot more pain ahead. And people are just so anxious for that pivot that will suddenly like explode the, money printer and send Bitcoin to 100K. But we could be very far away from that.
Yeah, see, that's the thing. We've all been, we now live in the age of instant gratification, right? I click on this, I click on that, I immediately have results. We got to recognize what happened the last few years in terms of liquidity. It's so easy to get your perception completely warped. And that's what happened to the folks in 2002. Maybe some may argue a greater degree. I would argue to a lesser degree. I mean, what you're seeing with the blowups in crypto, if you're a long-time Bitcoin bull, you actually should be really liking it. And I'll tell you why. Because these type of bubble blowups get rid of the nonsense. They get rid of the bad business models. They leave standing the long-term winners. Pets.com gone, right? I mean, that's the thing. And yes, I go back to 200% market cap to GDP. People, you gotta at some point have an economy that produces something to back up these valuations. You can't be living in la la land forever. And that's what I kept warning about last year, right? Even with Bitcoin at the time, because I had my little journey, and I certainly wasn't chasing all this stuff into 50, 60, 70,000. That's why I'm looking at it from a long-term perspective. And I was like, yeah, give me weakness, bring it, have things blow up, give me better prices. I'm all for it, but I'm not doing this for get rich quick scheme. Is that's what you call it, right?
Get rich quick. Don't get poor slowly, faster and faster.
Well, what happens is people are getting poor quickly because they over-levered themselves. This is the problem. Every generation forgets, that bubbles blow up, and everybody thinks everybody's a genius. If you make 50, 60, 70% on a trade or 1,000% on an option trade, that's great. But that's the most dangerous thing to happen. A lot of people came into trading fresh last year, right? The most dangerous thing, seriously, and this happened to me too, I was young once too, the most dangerous thing that can happen to you as a new trader is you start trading and you make a bunch of fucking money because you think you're a freaking genius. No, you're just in a particular market phase where everything works, and after it works, that's when people get cocky and they say, wow, I'm going to sell this to buy more of that. I'm going to level my house so I can get rich quicker, faster, richer. And that's when people blow themselves up. Sorry. There's nothing special about that time. It's just you're repeating the next cycle as the next generation. Sucks. That's heartless.
I agree with you. And I do think that there's something really healthy in the sense that there seems to be true capitalism in crypto with these wipeouts of companies, because in real capitalism, risk is rewarded, but it's also punished. There is no Fed put that's going to come in and save the day and, flow liquidity through this sector. And I think that's a good thing because you actually see what happens when the tide comes out. And we're not able to see that in traditional markets right now because the Fed will always come in and save the day, right?
Well, that's been one of my long-standing criticism by constantly intervening. 2009, I don't blame him. 2008, I mean, we're literally hours away from everything blowing up for good. That was really the financial system being ready to melt down. So I don't blame him for intervening. But I can blame him for intervening 2011, 2012, 2013, 2018. By never letting the system cleanse itself out, you're creating a zombified economy that's going to be weaker in the long term. It's going to be more inefficient in the long term. And so I agree. Yes, they don't intervene in the crypto space, and you do see the blowups and you see up the layoffs, and it's painful, but ultimately that makes it better. That's how you make things better. That is what capitalism is about. Survival of the fittest. Get rid of the crappy business models. Why are we subsidizing everything?
Yeah.
Why the free money?
Right.
And that's the shame in all of this. And you hinted at this earlier, is what has it produced? Just the most insane wealth inequality equation ever. And the middle class has been shrinking for 40 years straight.
Yep.
How that is the foundation of a long-term structural, not only economic, but also political system is beyond me. Because here we are. You mentioned, left, right, whatever. I mean, that we are seeing the most polarized political system ever that is basically completely inept and incapable of finding proper consensus. The only consensus they'll ever find is spending more money.
Well, that's actually where I wanted to end and ask you a question, because I get asked on these news programs, right, about the current situation. And I try to at least spark the curiosity about Bitcoin and why we really, really need it, especially if we want to sort of rebuild an economy based on value as opposed to debt. But let me ask you, because obviously when I go on news programs, especially if they're cable, they tend to be either on one side of the political spectrum or on the other. And the unfortunate thing we see is right now, whoever's in office, the other side can blame really easily, right? That the administration, that's why we have the inflation. That's why we have, these issues. So how do you respond when you have, okay, let's say, you're on a show where they're saying, well, Joe Biden created this inflation. That's why we have these problems. How do you pivot people with a general background, no knowledge of, economics, that this isn't because of red or blue, this is decades of bad policy, and whatever happens at that Fed meeting is not because Joe Biden was in office necessarily?
Well, fortunately for me, so far, I've never had to kind of delve into the political aspect of it. I'm trying to stick to only markets and what I see, Fed and economy and what have you. This is a broader discussion. I will just maybe offer this one. First of all, with the channel media you talked about, you got to recognize one thing. They are businesses. They're catering toward their audience, right? And so you have, unfortunately, in that sense, you have a filter, right? And unfortunately, I'm just a citizen myself, right? In the world, we are in a world where political power is institutionalized. In the United States, you got two parties that control everything, and they work their way through with redistricting. Here's a basic statistic, all right? Congressional approval ratings are in the toilet. Everybody hates Congress, but individual members of Congress have a re-election rate of north of 90%. That's where you get the sense, the system may well be rigged in favor of the incumbents in terms of money, in terms of you don't have a real democracy in this sense at all. I mean, the United States is a republic anyway. I'll give you one example I find actually interesting, and there's no political filter here. It's just a reality. The Senate, for example, in the United States, you got two senators from each state, right? And Senate, as you well know, very much divided. California has what? 45 million, 50 million people? Two senators. North and South Dakota, what, 3 million people? 4 senators. You don't have equal representation in that base. So, you can argue, you can block things one way or the other, right? You have a filibuster. You need a majority. And unfortunately, and I'll take this back to the Fed. If you want to understand the real capability of Congress to manage programs, watch the type of questions that are being asked of the Fed chair in congressional meetings. It is painful because it really shows the complete lack of understanding of anything in terms of how the Fed works, how the economy works, how policy works. So we, unfortunately, and this is just applying to all of us, we don't have the A team in charge in the world. And unfortunately, and I'll finish on this point. Here's the other problem. We live in this age of social media, and my God, if you post anything, and you have some sort of following and it goes viral, you will get hammered from some group of people, no matter what you say. And I think, and to be fair to politicians here, in one regard, is I think it's really hard for anyone to be having such a broad appeal that they can build a societal consensus. And with these business models that are living off firing outrage in both directions, you're met with a polarized audience that doesn't even agree on the same reality. If you don't agree on where the sun rises in the morning, you're not going to come to consensus on complex structural situations. So I'm worried, deeply worried, that the best systems that we've created as human beings, which is democracy and freedom and actually discourse, is breaking under its own structural limitations, maybe accelerated by what we see. We're young as a species, all right? Did you realize, we're talking about going to Mars. Did you realize it was only 100 years ago when we got refrigerators in the house? All right, 100 years for refrigerator. All right, we're all our brains are bombarded with all this information and opinions and data, and we don't know how our brains ultimately will handle this. And maybe this is all part of a growing pain. Fine, but I'm kind of worried it's turning some people really into kind of a devolution type of thing in terms of not just lacking critical thinking. And that's when you look at some of the comments you get and go, what was that? where does this come from? How do you govern? How do you govern in this type of environment? And I unfortunately, I think we're just right now in the point where consensus is really difficult. Problems are very complex, and we don't have the leadership that can pull it off. I mean, look at Italy, right? Draghi became prime minister without being elected by the people. Boris Johnson originally became prime minister in the UK without being elected. Then he ultimately got elected, but now we got a new prime minister who's also not going to be elected by the people. Where's the democracy in all this? Central bankers are not elected at all. I mean, and they're the most powerful people on the planet in terms of the global financial system. So, do we really have a democracy? I don't know.
No, I think that's really interesting. And it kind of goes back to something I've heard you say before in videos, where this kind of our monetary and fiscal policies have led us to this place where the wealth concentration has ballooned so much that it places such a pressure on society. People feel left behind and frustrated. It's social media helps, with venting that, but social media didn't cause it and spark it. It's really, I think, the lack of economic opportunity and the feeling of you don't have economic dignity when it's so hard to just make money and afford the things that are going up in price. And so that sparks these populist movements. And I think crypto is one of those populist movements in general, because especially young people who think technology can fix everything, they're like, this is our turn. We deserve a shot at a system that's left us behind, that's really unfair, and we're going to fight for it. So, Bitcoin, I can understand why people look at it from the outside and say, well, it's almost a religion. It's like this cult cult-like mentality, because it's a feeling that has formed into a big community of just, we want to burn the previous system down and we're going to do it. We're going to take over, because otherwise, what's the future look like? We can't afford to have kids. The planet's like, dissolving into a climate crisis. It's just a fascinating time to be alive. And you've kind of touched on some of that before. That's why we have these divisive leaders and everything that's feeding off of this feeling of just frustration, I think.
That was basically the core premise of my article at the beginning of the year, called Revolution. We have no say in any of this. The system that has been imposed upon us has resulted in the middle class shrinking ever more. Yes, on a global basis, there have been massive improvements on poverty, but when you have the type of explosion in wealth inequality, and I hate to say it, it breeds social discontent. And yes, you're absolutely right. Maybe social media is partially to blame, but maybe it's just simply a venting mechanism for people to be so extremely frustrated. And, look at it this way, people keep jumping from leadership to leadership. Obama was the great savior. Trump is our savior. And now Biden's our savior. Are they really? No. The problem is too, and, I'll say this for these guys. They may come into office with high expectations, but I think they also realize how the system is so confined that their power to actually do something structurally is very limited. I mean, the founding fathers were very clever. They said, we don't want a dictatorship. We want, a divided government, executive, legislature, executive, all that. But it's gotten to the point where no one can really do anything of consequence, which is fine if things kind of doodle along. But when things get really difficult, and maybe this is the way you got to think about it. Maybe the Fed's easy money policies over the last 14 years are a symptom of this, because while the solutions require political, or the problems require political solutions, they're not forthcoming from the political side, because the political side is frozen. It's inept. It cannot do it. So they've resorted to basically the Fed being the savior each time. We're going to solve our problems, or we're going to mask our problems with easy money. We're going to mask it again with easy money. You guys can't solve this. We cut rates to zero. You can't solve this. We cut rates to zero. That's literally how every crisis has been managed, right? And maybe then zero rates are a reflection of the bankruptcy of the political structure.
Mm-hmm.
And it won't change until the Fed says, no, we're not going to bail out your election cycle again, because that's at the end of the day what it's all about. Let's be clear.
Yes.
Okay. But at the same time, we don't want social chaos and disintegration, which you would have if you don't intervene. So it's a ridiculous trap. And unfortunately, I don't see at all where this is going to improve without a major calamity. People can be divided all they want to be. They come together when they're forced to come together, when they're forced to depend on each other. Right. So, I hate to be too philosophical about it, but maybe it won't get better until it gets really bad first. And I don't want to see that happen either, but that's kind of the train we're on. So,
well, you're right. And you're right. We have gone from a capitalism system to creditism, and that all feels really nice at the beginning, right? It's like a drug high. But then when the withdrawal comes, which I would say we're in that sort of period, you either have to let it come crashing down hard, which they won't. They won't admit that they have to do QE forever. At this point, you have to expand in order to keep this going, or have this massive crash that no politician will admit to or afford for an election. And thank goodness we have Bitcoin, because if the only alternative was to have a massive crash or this ballooning wealth inequality as the result of more creditism, I don't know. That's why I'm really passionate about Bitcoin. So Sven, it's been great to talk to you. Any final messages or takeaways? Thank you so much for all your time.
Natalie, it's been a great pleasure. I'm glad nothing fell on me while I was sitting out here. You never know in nature. So, no, look, I just in general would say, be careful of narratives. And just keep an open mind in everything. This is a really complex time. There's times to be bullish, there's times to be bearish. And I think maybe the big lesson for a lot of people this year was the lessons in the past. Be careful with leverage. Be clear what your trade strategy is. Know what pain you can take or willing to take. And also don't panic. And keep at it, because I think while we can be critical of the system, we also live in arguably some of the best times in human history. The fact that we can speak like this is fantastic. I like that.
Yeah, for sure. Thank you so much, Sven.
Thanks, Natalie. Take care. Until next time.